Hi everybody, this is Peter Schiff. This is Wednesday, September 2nd, 2009. Also remember, later on this evening I'll be doing Wall Street Unspun on the Europac site, www.europac.net. It's 5 p.m. West Pacific time, 8 p.m. Eastern time. First of all, the markets today, the stock market tried to rally but couldn't do it. The Dow actually ended up tacking on another 30 points to yesterday's decline. But I think the very interesting part of today's action builds on the divergence that I pointed out yesterday on this blog with respect to gold. Gold prices were up $5 an ounce yesterday despite a 180-point decline in the Dow. And I say despite because recently, going back to 2008, we've had this positive correlation between asset classes, where gold and stocks and other commodities all fall simultaneously and then rise simultaneously. Well, we didn't have that yesterday, and I thought that was very interesting. And of course, today we built on that momentum. Gold gained over $20 an ounce today, maybe $25 an ounce, despite the fact that the stock market didn't rally at all. Gold stocks put in a very impressive day. The Philadelphia Gold and Silvers Index, HUI, was up better than 9%. And many individual gold and silver stocks that I follow and that I own were up better than 10% on the day. Very, very strong movement. Also, another divergence that was very interesting to me was the strong day in both the Japanese yen and the Australian dollar. Both of those currencies surged on the day. Now, one of the things that we've had over the past year is those currencies moving in the opposite direction. When investors were nervous and fleeing assets and looking for safety and liquidity, there was always an unwinding of this yen carry trade, and there was a movement to the dollar and to the yen. And so the yen would strengthen, and the more aggressive commodity currencies that are more linked to economic growth, like the Australian dollar, would go down. And so you'd have the yen up and the Australian dollar down, or the Australian dollar up and the yen down. Today, we had a huge move up in both the Australian dollar and the Japanese yen. Again, that shows me that these relationships are changing. And what's actually happening is the mood is going from fearing deflation to fearing inflation. And so if we have another major decline in U.S. stocks, which is certainly likely, I think it's going to look very different than the decline of 2008. Because instead of fleeing to the dollar, because people fear deflation, they're going to flee the dollar because they fear inflation. And they're going to embrace commodities, and they're going to buy gold. And so you're going to see these relationships changing so that they're inversely correlated and not positively correlated. And I think that's a significant development that has probably already begun to take place. Also, I wanted to mention my appearance yesterday on CNBC's Fast Money. It was interesting that while I was on the show, I pointed out that the worst of the economic crisis was in front of us, not behind us. Now, once my segment was over and I was off the air and couldn't comment, one of the panelists pointed out, referenced that statement and said, well, this is impossible. He can't be right. I mean, look at what we've just gone through. That must have been the worst of it. How can the worst of it be in our future? And what that, again, shows me is that most people on Wall Street still don't understand the nature of our problems. They still don't understand that the problems are government-made, that the problems are these artificial booms that the government creates to try to solve a problem, which simply exacerbate the problem and postpone the consequences to a later date. So we know, based on what the government has done, based on the stimulus and the bailouts, they have created a much bigger problem than the one that they purport to be solving. And, this is what has defined the entire Greenspan era. And I think we're going to have many of these mini booms and major busts where we have progressively smaller and smaller booms that necessitate bigger and bigger busts. If you think about it like a drug addict who builds up a tolerance, as you take some drugs, as you can tolerate it because you're using it, you need more and more. You need a bigger and bigger dose to get the same effect, to get the same high. But then, of course, when you stop taking the drug, you have a bigger come down, because you had more drugs in your system. And this is the dynamic that exists in our economy, where the government comes in and worsens the problem as they attempt to solve it, and they create a bigger problem. And the bigger problem that I see coming in the very near term is going to be a significant drop in the value of our dollar, which is going to send consumer prices and interest rates up, which is going to worsen the economy. Meantime, in the last year, in the name of fixing the economy, we've taken on trillions of additional debt. We haven't allowed the real restructuring to take place, which means we haven't laid the foundation for real job growth, the real gains in productivity. It's all been an illusion. Also, I wanted to mention, I happened to be on the internet, on YouTube, and I saw an interview, and I think it's a few years old, but it's the point that matters, and you've got to see this to believe it. And so in order to see it, if you go on my video blog site on schiffreport.com, I favorited this video. So it's the top one. So you just go into my favorites, and you can play the video. But this guy, Jan Henschfeld, interviewed Congressman Peter Stark. Peter Stark has been in the Congress for a long time. He's a powerful Democrat. He's a ranking member of the Ways and Means Committee. Right? And this guy, Henschfeld, is interviewing him about the deficit. And you got to watch this. It's incredible. But this is the stuff that I'm going to have to deal with. This is the mentality that I'm going to have to deal with if I actually get elected to the U.S. Senate. So it certainly shows that I got my work cut out for me. But this guy was actually stating that our national debt was a sign of how wealthy we were. That the more debt we had, the wealthier we were. He was trying to explain to this individual that when governments have debt, it's not like when individuals have debt. That when individuals have debt, that it's a bad thing. But when governments have debt, it's a good thing. The more, the better. I mean, you can't even believe this interview. And then when this guy, Henschfeld, is asking him some very pertinent questions, he just dismisses him. He says, well, your questions are ridiculous. They're simplistic. He asks him, where did he go to school? And he mentions he went to the university in Puerto Rico, in which case this guy really starts to belittle him. He says, well, do you have a PhD in economics? Do you have a master's degree in economics? He goes, you need to go back to school. You need to study economics, because if you studied economics and you got yourself a PhD, then you'd understand why debt's a good thing. I mean, it's actually unbelievable. I mean, what he wants this guy to do is to go to school so he can get indoctrinated, so he can be brainwashed into thinking that, up is down, that black is white. And at the end, the congressman gets so frustrated that he throws this guy out of his office and he starts cursing at him. He threatens him with physical harm. So anyway, you got to watch this thing. And also, when you go to my favorites on YouTube, you might want to check out. Somebody sent me a YouTube video. This guy, Tim Hawkins, performed a tune, The Government Can, to the tune of the Candyman. And it's very entertaining. I think it's worth a look. Anyway, that's it for today, everybody. So long.